welcome to Cuan Group Investment Channel. We are from Ipmi Business School, MBA students of class September 2023. We are going to review a book with title 0 to 1. This book review mentored by Professor Roy Sambal. Today we are talking about 14 chapters for anyone trying to start their own business and explore new ways to create a product or service. 0 to 1 was a fantastic book for entrepreneurs. This book will give you plenty to think about. This book was written by Peter Thiel, German-American entrepreneur and billionaire that co-founded PayPal, billion-dollar company, Palantir, and was a large initial investor of Facebook. Peter was providing lectures to students at Stanford University, and one of the students, Blake Masters, turned his note into this book, 0 to 1.
We go to chapter 1, Challenge of the Future. When Peter interviews people, he likes to ask them the unique truth they know that very few people agree upon. It's a hard question because the American education system is flawed. When we have learned something to be true, it is also something that a majority of people have agreed upon. Peter writes about progress, about horizontal progress. It's easy to imagine. That is when you improve something that you already know works, that will take you from A to Z. Vertical progress is harder because you need to do something that has never been done before, that will take you from 0 to 1. Like China is prospering by horizontal progress because globalization has allowed this to happen by copying or improving something that already exists. But you will not get ahead with this. Technology is what has to be taken for us from 0 to 1. You can have both horizontal and vertical progress, one at a time, or neither. Right now we experience globalization, but have limited technology process. The progress has been mainly on IT, but the important is the future depends on technology, not on globalization.
Chapter 2, Party Like It's 1999. The 90s had a good image until the dot-com bubble burst. Peter Thiel himself was scared about a crash in technology market while he was running PayPal. PayPal was considered one of the 10 worst business ideas in the 90s. For PayPal to work, they needed 1 million customers as a critical mass. After early struggles, the growth rate became exponential when the company introduced a campaign where new customers were awarded with $10 for each time they submitted. The campaign was effective as it was also unsustainable, but the strategy worked and it attracts so many investors. The capital was enough to buy PayPal time to make it success before the bubble burst. At the end of the bubble, Peter develops lessons learned that contradict conventionally with the Silicon Valley wisdoms. Number 1, it is better to risk boulders than triviality. 2, a bad plan is always better than no plan. 3, competitive markets destroy profits. And 4, the last, sales matter just as much as the products.
Chapter 3, All happy companies are different. Consider the airline industry, which has created a lot of value, but few companies can make a profit. Compare this to Google, that is creating less value but is keeping the profits. Google makes so much money that it is worth more than 3 times the value of all American airlines combined. Economists explain this by categorizing Google as a monopoly. The high profit is made as consumers would have to pay a higher price for goods and services. Compare this to the airline industry, which Peter described as a perfect competition. Most profit is washed away by fierce competition by rivals in the market. Peter Thiel likes the idea of a monopoly. Consider Google dependent on your definition. It has a monopoly for search engines. Google does not have to constantly focus on competition, but can focus on innovation. The lesson is clear: if you want to keep the profit and progress, you should build a business that has a very unique competitive advantage where rivals can enter.
Chapter 4: The Ideology of Competition. Competition means no profit for anyone from a pure theory position. So, why do so many people like the idea of competition? It is an ideology that our education system preaches more than anything else. The best students get good grades and prestige if they solve the same assignment as everybody else, just marginally better. The competition continues and becomes even featured in higher education. The best of the best students are typically rewarded with conventional and non-innovative jobs in law or management consulting. The opportunity cost for society are enormous. Everyone is thinking alike.
Chapter 5: Last Mover Advantage. The value of a business today is all the future cash flow from that company after being discounted at an appropriate rate. An old, low-growth company, like a newspaper, might hold its value if it can sustain the current cash flow for 5 till 6 years. But often the value of the company dwindles as customers move over the alternative products. Growth companies have the opposite trajectory. Some high-growth company might be losing money in the early years and have the potential for significant cash flow in the next 10 till 15 years ahead. PayPal and LinkedIn are a sample for this. By the way, the investors are a little skeptical of Peter's enthusiasm for some growth company and his earning forecast. For a company to be valuable, it must both grow and endure. He suggests focusing on short-term growth because it is easy to measure. This company focus on monthly revenue chart and quarterly earnings reports. The most important question to ask is, will this business still be around a decade from now? Numbers alone will not give you the answer. You must critically think about qualitative characteristics.
Chapter 6: You are not a lottery ticket. Many celebrities, including Bill Gates or Warren Buffett, argue that luck has a big influence on their success. Well, Peter argues about this one. He said that we might be too quick to dismiss anyone who succeeded according to plan. The reader of this book should have the same opinion with Peter. Why else she or he read this book if success was something completely random? Perhaps we should look to the Steve Jobs. He is the proof that you create your own success. He didn't ask the opinion of the focus group discussion. He designed for perfection and he knew what he wanted. The main lesson to learn from Steve Jobs was he envisioned and executed long-term plan to distribute innovative. That's the chapter 6 tell us about.
In 1906, the Italian economist Wilfredo Pareto was discovered what would be known as the Pareto principle. It was a concept known as the 18-20 rules. The 18% of the output were produced by 20% of the populations. The monopolies grabs more profit than combining a majority of the whole competitors. Money follows the same pattern. As an investor in venture capital, you should not over-diversify as the returns are not normally distributed. For example, some companies will fail, more companies will stay flat, and few superior companies will potentially return 10 times their initial investment. In reality, the investor should focus on the new superior companies to get that exponential results. Peter Thiel's investment in Facebook was outperformed from the combined return of all the other investments they made. Second best investment is Palantir is said to make a higher return than all the investment combined aside from the Facebook.
Chapter 8 Secrets. Why do so many people believe that there are no secrets to be revealed anymore in the world? It might start with geography. Just 150 years ago, a lot of the world had not revealed itself to anyone. Today, just by watching the Discovery Channel, everybody in the Western world can see even the most remote location from their couch. There are plenty of secrets to be revealed, but if you don't believe you can find secrets, you will never find them. We see in the stock market where the common truth is that you as an individual investor can know more than the combined market. In all social settings, there are the prospects that you might be right, but unless the truth has been vetted as conventional wisdom, few people will take the change and perhaps be left alone.
Chapter 9 Foundations. Founding a company is just like building a house. You can't build it on flawed foundation. The most critical decision when building a company is whom you start it with. Choosing a co-founder is like getting married, and a founder conflict is just as ugly as a divorce. No one wants to think about what will happen if it goes wrong, and thereby they don't do it. When investing in a company, you should consider the founding team. Technical skills matter, but how the founders work together is just as important. In a startup company, there is a potential for conflict when ownership and control changes. This typically happens between the founder and his investors. A classic example could be founder wanting to grow the company and keep it private, while the investor would like to cash out through an IPO. The board is very important. As a founder, as well as an investor, you should strive for small boards of 3 until 5 people. Small board ensure execution and effectiveness. As a founder, you should look to employ people to have equity or regular full-time salary from your company. There is an exception for lawyers and accountants. However, everyone that does not own stock option or draws a full-time salary is fundamentally misaligned. They are biased to claim value in the short term or not create value for future. That's why part-time employees and consultants don't work well. You are either on the bus or off the bus.
Chapter 10 The Mechanics of Mafia. The first team Peter Thiel built has been known as the PayPal Mafia. The reason is that so many of his previous colleagues have later helped each other with the foundation of a variety of great companies including Tesla, LinkedIn, and YouTube. The strong culture that originally shaped PayPal was not assembled by hiring the most talented people from a pool of applicants. Instead, it was assembled by people of similar interests and work ethics, and they had a very common goal they were working towards. Recruiting should never be outsourced. As an employer in a startup company, you should know the answer of the following question. Why should the 20 employees work for you? Talented people do not need to work for you. They have plenty of options and could likely work for a higher pay in a more prestigious company elsewhere. The right answer is specific to your company and relates to the mission and the theme of the company. If you do not know the reason, the importance will not be unique and you won't get the right talent.
We go to chapter 11. If you build it, will they come? In this chapter, talk about advertising. In Silicon Valley, people usually skeptical about advertising. Well, they should not be, because advertising is work for everybody. And if you don't acknowledge it, then you are deceiving yourself. Advertising is not about like we see on TV to buy a product right now, but as a matter of fact, sales work best when it's hidden. Consider this. People that sell companies, usually we call it investment banker. people that self, herself or himself, we call it the politician. As a startup company, the companies should resist the temptation to compete with conventional company using the conventional way to elaborate the PR stunt. But instead, startup company has to focus to do a viral marketing that can lead to exponential growth, to inform to the others what they can do, what they innovate. So that's the important item mentioned in this chapter.
Chapter 12, Men and Machines. Many people are concerned that the machines will replace us in the future. Self-driven cars, for example, may replace taxi drivers in the future. But in reality, it is not that simple. Computers and machines are not good at the same things. Computers can work with a large number of data, but contrary of the people, computers will never ever be able to make a holistic judgment. When you combine strengths of machines and the strength of the people at the same time, you will end up with something great. Machines and people are not rivals, and they do not compete or not replace each other like globalizations. In this chapter, Peter lists 7 questions that every founder should answer before starting a business. 1. Can you create a breakthrough technology? 2. Is it at the right time? 3. Are you starting with a big share or small segment of market? 4. Do you have the right team? 5. Can you deliver your product? 6. Will your market be defensible in the future like 10 or 20 years from now? And the last 7, have you identified the unique opportunity that others do not see in the product?
Chapter 13, Seeing Green. At the start of the 21st century, everyone looked to the green technology. Politicians were mobilizing the population and investors to pour billions of dollars into the new world of clean energy. It all turned out to be a bubble due to gross government intervention and the supply of capital ahead of technology maturation. Companies forgot how competitive the energy market was. They looked at the overall market and thought they could strike gold if they captured a fraction of the market. Being a small fish in a big seas is not a good approach. The most successful companies start with the goal to dominate their niche before entering in harder and larger markets. Just think of Facebook. They started up as a network just for a single campus. Another mistake is to be careful of simply investing in a market with huge potential alone. Simply being a part of an industry that is bound to grow does not create any prosperity for the investor by definition. Companies cannot operate on a macroeconomic trend alone. We saw the same mistake as IT or information technology companies permeated the tech market in the late 90s. All individual companies must have a plan and product or services to support the value they will actually add to the emerging industry.
Chapter 14, The Founder Paradox. Founders' traits are often extreme. They do not follow the normal distribution. Perhaps they are closer to being inversely distributed. Think about the founder that is cash poor but treats in terms of the equity in his company. Or think about how many charismatic founders are both insiders and outsiders of their business. Peter contemplates the ago-old idea of whether leaders are born this way or if their environment has shaped their behavior. Perhaps we all need a king that we can idolize when things are good, or a scapegoat that we can cast away when we don't like them any longer. Stagnation or singularity. It is hard to say what the future will look like when even most far-sighted founders can't look more than 20-30 years ahead. We can't take for granted that the future will be better, and it means that we need to start changing that today. Everything important to us is singular. Our task today is to find singular ways to create new things that make the future not only different but better by looking at everything as if it were new. We need to go from 0 to 1.